The composite operator reveals his hand through violent rejection, a long wick-piercing resistance, only to snap back with force. This is not random price action, it's the footprint of absorption. When smart money distributes into eager buyers at supply zones, the pin bar emerges as evidence of their completed operation. Master this single formation, and you'll read the intentions of the professional money before the crowd realizes they've been positioned against. When you are USD thrust above 1.1000 psychological resistance with a 50 pip spike, only to close 45 pips lower within the same hour. The resulting pin bar signaled professional distribution. The composite operator had absorbed all buying pressure at that level, leaving retail traders trapped as price reversed into a 200 pip decline over the following sessions. Let me explain to you precisely what occurs when we observe this phenomenon the market participants have come to call the pin bar or rejection candle. You must understand that every movement in the market, every thrust and retreat, is the result of definite causes, and those causes are the deliberate operations of the composite operator. When you witness price thrust violently in one direction, creating that long wick or tail, you are observing a planned campaign. The composite man, that is, the combined influence of the largest professional interests, has engineered this probe for a specific purpose. He is not speculating blindly. He is testing the waters, determining how much supply exists at higher prices or how much demand waits at lower prices. This is scientific market operation. The anatomy of this formation reveals the entire story of the battle between the professional and the public. Consider the long wick extending upward from the candle body. What has transpired here? The composite operator pushed price higher, advertising opportunity to the masses. The uninformed public, seeing this upward movement, rushed in to buy, convinced they were catching the beginning of a strong advance. But this is precisely what the composite man anticipated. At that elevated price level, he was waiting with his inventory. As the public bought with enthusiasm, he distributed his holdings into their eager hands. Every share or contract the public purchased, he sold. This is absorption in its purest form. He absorbed every bid, every particle of buying pressure, until there was nothing left to fuel the advance. Then observe what follows the rejection. Price snaps back violently, leaving behind that extended tail. The small body of the candle, whether bullish or bearish in color, is inconsequential. What matters is the relationship between the range and the close. The market traveled far from the close, proving weak hands were shaken out or trapped, then returned near its origin, demonstrating that the professional money rejected those extreme prices. This is not the footprint of retail sentiment. The public does not possess the capital to create such violent reversals. When you see price probe an area and immediately retreat, leaving behind this distinctive signature, you are witnessing institutional activity. The composite operator has completed his operation at that level. The wick's length tells you the extent of the trap. A longer tail represents more aggressive absorption, more public participation at unfavorable prices, and consequently a stronger potential for reversal. The composite man has positioned himself on the correct side of the market, while the crowd finds itself trapped, holding positions at the worst possible prices. This is the language of the tape, speaking to those who have learned to read it. The rejection candle is not merely a pattern to trade mechanically, it is evidence of completed professional operation, and therefore an indication of future direction. Study it as such, and you position yourself alongside the composite operator rather than against him. I must impress upon you a critical truth that separates the professional operator from the amateur speculator. Context is everything. A rejection candle appearing in isolation, at some arbitrary price level with no structural significance, is merely noise in the market's endless chatter. It signifies nothing, it offers no edge. Trading such formations is the hallmark of the uninformed, those who have learned patterns but have not learned to think. The composite operator does not waste his capital creating rejection formations at random locations. Every campaign he undertakes requires enormous resources, capital, coordination, and calculated timing. He reveals his hand only when defending positions of strategic importance or when attacking critical zones where the public has concentrated their commitments. You must train yourself to identify these zones, for they are the battlegrounds where fortunes transfer from the many to the few, where then Do meaningful rejections occur? First, examine the previous areas of accumulation and distribution. These are price levels where the composite man previously conducted extensive operations, where he accumulated inventory from frightened sellers or distributed holdings to eager buyers. These zones remain in his memory, and more importantly in his position books. When price returns to these levels, he is prepared to defend them or exploit them once again. A rejection candle at such a location carries the weight of institutional commitment behind it. Second, consider the swing highs and lows, those prominent peaks and valleys that define the market's structure. These are not merely lines on your chart. They represent where the public stops are clustered, where their psychological pain points exist, where their hope and fear concentrate. The composite operator knows this. When he drives price to a previous swing high and you observe a violent rejection, he has triggered the public stops, absorbed their forced buy, and positioned himself for the reversal. This is planned operation, not accident. Third, observe the psychological round numbers, those price levels ending in double zeros or significant figures. Why do these matter? Because the undisciplined mind of the public gravitates toward them. They place their orders at 1.1000, at 50, at 2,000, believing these numbers possess some mystical significance. The composite man understands this mass psychology. He uses these levels as collection points, knowing exactly where the public's orders cluster. A rejection at such a zone tells you he has harvested those orders and is ready to move price in the opposite direction. You must develop the ability to distinguish between strategic locations and meaningless price levels. This requires study of the market's history, understanding of campaign development, and recognition of where the public has committed their capital. A pin bar at a tested support level that has held 3 times previously is not the same as a pin bar in the middle of a trending move with no structural significance. The professional trader waits for confluence, for rejection candles that appear at the intersection of multiple strategic factors. Only then does he commit his capital, for only then has the composite operator revealed his true intentions. Now we arrive at the very heart of market operation, the principle of absorption. This concept, when fully grasped, illuminates the entire mechanism by which the composite operator conducts his campaigns and why the rejection candle serves as such reliable evidence of his completed work. Understand first that markets move on the fundamental law of supply and demand. But the composite man does not simply react to this law, he manipulates it. He creates the conditions under which supply and demand become imbalanced, and he positions himself to profit from the inevitable consequence. The rejection candle is the visible record of this manipulation in action. When you observe price spike violently upward into that extended wick at a resistance zone, what is actually transpiring? The composite operator is conducting an absorption campaign. He has accumulated inventory at lower prices during a period of accumulation, perhaps over weeks or months. Now he requires an exit for these holdings at favorable prices. So he marks price up sharply, creating the appearance of breakout, of opportunity, of the beginning of a substantial advance. This upward thrust serves as advertisement. It attracts the attention of the uninformed public. The newspapers report the advance. The trading rooms buzz with excitement. The amateur sees price breaking above resistance and concludes, I must buy now before it runs away from me. This is precisely the response the composite man has engineered. As price reaches that elevated level, he stands ready with his entire inventory. Every share the public eagerly buys, he eagerly sells. This is absorption. He is absorbing all the buying pressure, all the demand, every last particle of it. He distributes his holdings into their enthusiastic bids until there is nothing left. The buying wave crashes against his supply and exhausts itself completely. Then comes the revelation. With all buying pressure absorbed and no genuine demand remaining at those levels, price collapses back, creating that violent rejection. The composite operator has completed his distribution. He now holds cash, while the public holds inventory purchased at the worst possible prices at the very top of the move. The inverse occurs at support levels. When price plunges downward into a long lower wick, the composite man is absorbing panic selling. He has engineered a shakeout, perhaps a spring below support, creating maximum fear. The public, seeing price break support, rushes to sell before further losses materialize. The composite operator stands ready to accumulate every share they desperately offer, absorbing all the supply until selling pressure exhausts itself. Then price springs back violently, leaving those sellers stranded. This is why the rejection candle possesses such forecasting value. It is not a predictor, it is a recorder. It records the completion of an absorption operation. When you see that extended tail, you know with certainty that the composite operator has consumed all available supply or demand at that level. The tank is empty, the spring is compressed, the imbalance has been created, and price must now move in the direction of least resistance, which is precisely the direction the composite man has positioned himself to profit from. I've often stated that price alone tells only half the story. To read the market with true understanding, you must study volume alongside price, for volume reveals the truth that price attempts to conceal. The composite operator can paint the price bars in any pattern he wishes, but volume exposes the reality of his operation. It is the footprint he cannot hide, the evidence he cannot falsify. When examining a rejection candle, your first instinct may be to focus solely on that dramatic wick, the violent thrust and retreat. But the discerning student of market behavior looks immediately to the volume that accompanied this movement. Here lies the difference between a genuine absorption operation conducted by professional money and a mere technical fluctuation of no forecasting value. Consider a rejection candle forming at resistance with expanding volume. What does this tell us? As price thrust upward into that wick, trading activity intensified dramatically. Orders poured into the market. This is not the quiet, controlled movement of a few participants. This is climactic action. The public, seeing the upward thrust, rushed in with their buying orders. Simultaneously, the composite operator unleashed his selling, distributing his accumulated inventory into their eager bids. This expansion of volume proves the completion of a genuine campaign. The composite man required substantial participation from the public to absorb his holdings. He needed their capital, their enthusiasm, their orders. The high volume confirms he received it. He has successfully transferred his inventory to them at elevated prices. The operation is complete, and the evidence is irrefutable in the volume figures. Now contrast this with a rejection candle on light volume. Price creates that same pattern, the upward probe, the subsequent rejection, but the volume remains unremarkable, perhaps even contracting. What conclusion must we draw? The composite operator has not yet completed his work. He thrust price higher, testing for supply or attempting to attract buyers, but insufficient participation occurred. He did not absorb enough opposing pressure to justify reversing his campaign. Such formations frequently fail because the necessary condition has not been met. The composite man will often make multiple attempts, creating several rejection candles on light volume, until finally the public responds in sufficient numbers. Only then, when volume expands climactically, does the true absorption occur and the reliable reversal commence. Pay particular attention to where the volume climax occurs within the candle's formation. The professional operator concentrates his heaviest activity at the extreme of the wick, the very point of maximum extension. This is where he completes his distribution at resistance or his accumulation at support. If you observe volume surging as price reaches that extreme, then rapidly declining as price retreats, you are witnessing the signature of professional operation. Volume, my students, is the steam that drives the engine of price. Without sufficient volume, there is no fuel for sustained movement. The rejection candle with expanding volume tells you the composite operator has loaded the engine with fuel for the journey ahead. The rejection on light volume tells you he is still gathering resources, still preparing. Learn to distinguish between them, and you align with the true forces moving the market. Understanding the rejection candle is valuable, but understanding alone does not produce profits. You must translate this knowledge into disciplined action, into precise entry points and intelligent risk management. The professional operator does not speculate recklessly. He calculates his risk with mathematical precision before committing a single dollar to the market. You must do likewise. The question inevitably arises, when exactly should I enter the position? The answer depends upon your temperament and your confidence in reading the formation. The aggressive trader, one who has thoroughly analyzed the context and confirmed the volume characteristics, may enter immediately upon the close of the rejection candle itself. At this moment, the evidence is fresh and complete. The composite operator has revealed his hand. The absorption has occurred. Why delay? However, I recognize that many traders, particularly those still developing their judgment, prefer additional confirmation before risking capital. This is not weakness, it is prudence. For such individuals, I recommend waiting for the first pullback that holds above the body of the rejection candle in a bullish setup. What does this accomplish? It demonstrates that the character of the market has indeed changed. The pullback tests whether sellers remain aggressive at lower prices. When price holds above the rejection candle's body, it confirms that supply has been exhausted. The composite operator's absorption was genuine, and the public trapped at the extreme lacks the strength to push price back down. Now we address the critical matter of stop placement, the difference between the professional and the amateur. Where does the uninformed trader place his stop? Typically at some arbitrary percentage below his entry, or at some round number that appeals to his undisciplined mind. This is speculation without science. The intelligent trader recognizes that the extended wick of the rejection candle marks the precise point where the composite operator demonstrated his control. He absorbed all opposing pressure at that extreme. He proved that price could not sustain itself beyond that level. Therefore, if price subsequently violates that extreme and travels beyond the wick, our entire premise has been invalidated. The composite man either did not complete his operation or he has changed his campaign. Either way, we must exit immediately. Place your stop just beyond, not at, but beyond the wick extreme. Give the market a few ticks of breathing room to account for minor fluctuations, but no more. This placement accomplishes two critical objectives. First, it defines a specific point where you admit your analysis was incorrect. Second, it provides exceptional reward to risk ratios, because the rejection candle by its very nature creates a tight, well-defined risk point. You can risk relatively small amounts to capture potentially substantial moves. Consider the mathematics. If the rejection candle's wick extends 30 points beyond its body, your risk is perhaps 35 points including your buffer. But if the composite operator has truly completed his absorption and begins his markup campaign, the potential profit may be 300, 500, or 1,000 points. This is the edge, not certainty, but favorable mathematics repeated consistently over time. Never enter a position without knowing precisely where you are wrong and where you will exit. The rejection candle provides this clarity naturally. Use it. I must warn you against the most common error committed by those who have learned to identify the rejection candle. They see the formation and immediately assume they have discovered a profitable opportunity. This is shallow analysis. It is pattern recognition without understanding. The professional trader knows that isolated signals, no matter how dramatic their appearance, possess limited forecasting value. What matters is the sequence, the logical progression of events that tells the complete story of the composite operator's campaign. Consider the market as a narrative unfolding across time. Each price movement is a sentence, each formation a paragraph. The rejection candle is merely one paragraph in this larger story. To trade it profitably, you must read the preceding chapters and understand how this formation fits within the broader campaign structure. Let me describe the ideal sequence that produces the highest probability rejection candle setups. First, observe a period of markdown or consolidation where prices worked lower, testing and retesting a support level. The composite operator is conducting accumulation during this phase, gathering inventory from discouraged holders. Volume should show characteristic behavior expanding on down moves as he absorbs selling, contracting on rallies as he withholds his buying to keep prices depressed. Then comes the critical event I have termed the spring, a false breakdown below established support. Price violates the support level that has held multiple times, triggering the stops of those who bought at support and creating panic among remaining holders. This appears to be a breakdown, a failure of support, the beginning of further decline. But observe carefully if this is a true spring. Volume should climax on this downward penetration as the composite operator absorbs this final wave of panicked selling. Then price reverses sharply back above the support level. Now the stage is set. The composite man has completed his accumulation. He has shaken out weak holders. He has gathered their inventory at favorable prices. When price returns to test that support level once more and forms a rejection candle, a long lower wick showing another attempted decline that failed, this is confluence of the highest order. But there is more. Examine the volume on this test. It should be declining, showing that selling pressure has been exhausted by the previous absorption. The spring removed the sellers, now there are none left. The rejection candle on reduced volume at a previously tested support level following a spring tells you with near certainty that the composite operator has completed his accumulation campaign and is prepared to mark up price. Conversely, at market tops, seek the sequence of rising prices, a climactic move upward on high volume, the buying climax, followed by tests of that high on reduced volume and narrower price spreads. When a rejection candle appears at resistance in this context, showing that the composite man distributed into the buying climax and now refuses to support higher prices, the downside potential becomes substantial. I must warn you against the most common error committed by those who have learned to identify the rejection candle. They see the formation and immediately assume they have discovered a profitable opportunity. This is shallow analysis. It is pattern recognition without understanding. The professional trader knows that isolated signals, no matter how dramatic their appearance, possess limited forecasting value. What matters is the sequence, the logical progression of events that tells the complete story of the composite operator's campaign. Consider the market as a narrative unfolding across time. Each price movement is a sentence, each formation a paragraph. The rejection candle is merely one paragraph in this larger story. To trade it profitably, you must read the preceding chapters and understand how this formation fits within the broader campaign structure. Let me describe the ideal sequence that produces the highest probability rejection candle setups. First, observe a period of markdown or consolidation where price has worked lower, testing and retesting a support level. The composite operator is conducting accumulation during this phase, gathering inventory from discouraged holders. Volume should show characteristic behavior expanding on down moves as he absorbs selling, contracting on rallies as he withholds his buying to keep prices depressed. Then comes the critical event I have termed the spring, a false breakdown below established support. Price violates the support level that has held multiple times, triggering the stops of those who bought at support and creating panic among remaining holders. This appears to be a breakdown, a failure of support, the beginning of further decline. But observe carefully if this is a true spring. Volume should climax on this downward penetration as the composite operator absorbs this final wave of panicked selling. Then price reverses sharply back above the support level. Now the stage is set. The composite man has completed his accumulation. He has shaken out weak holders. He has gathered their inventory at favorable prices. When price returns to test that support level once more and forms a rejection candle, a long lower wick showing another attempted decline that failed, this is confluence of the highest order. But there is more. Examine the volume on this test. It should be declining, showing that selling pressure has been exhausted by the previous absorption. The spring removed the sellers, now there are none left. The rejection candle on reduced volume at a previously tested support level following a spring tells you with near certainty that the composite operator has completed his accumulation campaign and is prepared to mark up price. Conversely, at market tops, seek the sequence of rising prices, a climactic move upward on high volume, the buying climax, followed by tests of that high on reduced volume and narrower price spreads. When a rejection candle appears at resistance in this context, showing that the composite man distributed into the buying climax and now refuses to support higher prices, the downside potential becomes substantial. You see then that the rejection candle alone is insufficient. It is the confluence, the convergence of multiple confirming factors that produces consistent profits. Train yourself to see these sequences, these campaign progressions, and you will trade with the composite operator rather than against him. We have journeyed together through the anatomy, context, principles, and application of the rejection candle, what the modern trader calls the pin bar. But I hope you understand by now that we have been discussing something far more significant than a mere candlestick pattern. We have been examining the very mechanism by which wealth transfer from the uninformed many to the informed few in the marketplace. The rejection candle is not a magic formula. It will not make you wealthy by its identification alone. What it represents is evidence, concrete, visible evidence that the composite operator has completed a campaign of absorption at a critical price level. It is a footprint left behind by professional money, a signature that cannot be forged by the amateur speculator. Your task, as a student of market behavior, is to train yourself to think as the composite operator thinks. When you observe a rejection candle, do not ask yourself, should I buy or sell this pattern? Instead, ask, what operation has the composite man completed here? Has he accumulated inventory from panicked sellers or distributed holdings to eager buyers? Has he defended a strategic position or attacked a zone where the public concentrated their commitment? This shift in thinking from pattern trader to market analyst, from technician to student of campaign operations separate those who achieve lasting success from those who experience temporary accidental profits followed by inevitable losses. Remember the principles we have covered. A rejection candle must appear in proper context at levels of strategic importance. It must demonstrate genuine absorption through expanding volume at the extreme. It must offer you clear, defined risk with favorable reward-to-risk mathematics. And most critically, it must fit within a logical sequence of price action that tells the complete story of the composite operator's intentions. The market will present you with hundreds of rejection candles. Most will fail. Many will appear compelling but lack the necessary confluence of confirming factors. Your discipline must be to wait to observe patiently until all elements align, until the evidence becomes overwhelming, until the composite operator's completed campaign becomes unmistakable. This is not easy. It requires study, practice, and the willingness to let opportunities pass when they fail to meet your criteria. But this is precisely what separates the professional from the gambler. The professional understands that preserved capital and selective execution produce far greater wealth than constant activity and undisciplined speculation. I leave you with this final thought. The market is not your enemy. The composite operator is not your adversary. They are simply forces conducting their business according to natural laws of supply, demand, and human psychology. Your opportunity lies in understanding these forces, reading their evidence correctly, and positioning yourself accordingly. Study the rejection candle not as an isolated phenomenon, but as one chapter in the larger book of market behavior. Master its language. Learn to distinguish genuine signals from false ones. Practice the discipline of proper entry, stop placement, and position management. And above all, develop the patience to wait for those rare moments when all factors converge and the composite operator's intentions become crystal clear. When you trade in this manner scientifically, systematically, with full understanding of the forces at work, you transform yourself from a speculator hoping for profits into a professional operator expecting them. This is the path I have set before you. Walk it with discipline, and the market will reward your efforts accordingly.